Introduction to Financial Market by Karthik. What is financial market? A financial market is a word that describes a marketplace where bonds, equity, securities, currencies are traded. Few financial markets do a security business of trillions of dollars daily, and some are small-scale with less activity. These are markets where businesses grow their cash, companies decrease risks, and investors make more cash. Meaning of financial market: a market wherein financial instruments such as financial claims, assets and securities are traded is known as a financial market. In other words, financial markets may be channels through which flow loanable funds directed from a supplier who has an excess of assets toward a demander who experiences a deficit of funds. Definition of financial market. According to Brigham, Eugene F., the place where people and organizations wanting to borrow money are brought together with those having surplus funds is called a financial market. A financial market is an institution or arrangement that facilitates the exchange of financial instruments such as equity shares, preference shares, debentures, deposits and loans, corporate stocks and bonds, government bonds, and more exotic instruments such as options and futures contracts. Financial market transactions may take place either at a specific place or location, for example stock exchange, or through other mechanisms such as telephone, telex, or other electronic media. Indian financial system can be classified into two types. They are organized and unorganized. The organized system is classified as follows: 1. Regulators. 2. Financial institutions. 3. Financial markets. 4. Financial services. The unorganized system is classified as follows: 1. Money lenders. 2. Indigenous bankers. Scope of Indian financial markets. The financial market provides financial assistance to individuals, agricultural sectors, industrial sectors, service sectors, financial institutions like banks, insurance sectors, provident funds and the government as a whole. With the help of the financial market, all the above stated individuals, institutions and the government can get their required funds in time. Through the financial market, the institutions get their short-term as well as long-term financial assistance. It leads to the overall economic development. Types of financial markets. 1. On the basis of type of financial claim. 2. On the basis of maturity of financial claim. 3. On the basis of time of issue of financial claim. 4. On the basis of timing of delivery of financial claim. 5. On the basis of the organizational structure of the financial market. On the basis of type of financial claim. This is classified into two types, namely 1. Debt market and 2. Equity market. Debt market. Debt market is the financial market for trading in debt instrument, that is, government bonds or securities, corporate debentures or bonds. Equity market is the financial market for trading in equity shares of companies. on the basis of maturity of financial claim. This is classified into two types, namely, money market and capital market. Money market is the market for short-term financial claim, usually 1 year or less, for example treasury bills, commercial paper, certificates of deposit. Capital market is the market for a long-term financial claim more than a year, example, shares, debentures. On the basis of time of issue of financial claim. This is classified into two types, namely, primary market and secondary market. Primary market is a term used to include all the institutions that are involved in the sale of securities for the first time by the issuers, companies. Here the money from investors goes directly to the issuers. Secondary market is the market for securities that are already issued. Stock exchange is an important institution in the secondary market. On the basis of timing of delivery of financial claim. This is classified into two types, namely, cash market or spot market and forward or futures market. Cash or spot market is a market where the delivery of the financial instrument and payment of cash occurs immediately. That is, settlement is completed immediately. Forward or futures market is a market where the delivery of asset and payment of cash takes place at a predetermined time frame in future. On the basis of the organizational structure of the financial market. This is classified into two types, namely, exchange-traded market and over-the-counter market. Exchange-traded market is a centralized organization, stock exchange, with standardized procedures. Over-the-counter market is a decentralized market, outside the stock exchange, with customized procedures. The above classification is not rigid. One market may come under more than one category. Role of financial market. 1. Savings mobilization. 2. Investment. 3. National growth. 4. Entrepreneurship growth. 5. Industrial development. Functions of financial market. This can be classified into two types, namely, 1. Intermediary functions. 2. Financial functions. Now let us discuss about intermediary functions in detail. 1. Transfer of resources. Financial markets facilitate the transfer of real economic resource from lenders to ultimate borrowers. 2. Enhancing income. Financial markets allow lenders earn interest, dividend on their surplus investable funds and thus contributing to the enhancement of the individual and the national income. 3. Productive usage. Financial markets allow for the productive use of the funds borrowed and thus enhancing the income and the gross national production. 4. Capital formation. Financial markets provide a channel through which new savings flow to aid capital formation of a country. 5. Price determination. Financial markets allow for the determination of the price of the traded financial asset through the interaction of buyers and sellers. They provide a signal for the allocation of funds in the economy, based on the demand and supply, through the mechanism called price discovery processes. 6. Sale mechanism. Financial market provides a mechanism for selling of a financial asset by an investor so as to offer the benefits of marketability and liquidity of such assets. 7. Information. The activities of the participants in the financial market result in the generation and the consequent dissemination of information to the various segments of the markets, so as to reduce the cost of transaction of financial assets. Functions of financial market. Now let us discuss about financial functions in detail. Financial functions. The financial functions of a financial market include the following. 1. Providing the borrowers with funds so as to enable them to carry out their investment plans. 2. Providing the lenders with earning assets so as to enable them to earn wealth by deploying the assets in productive ventures. 3. Providing liquidity in the market so as to facilitate trading of funds. Classification of financial assets. Financial assets can be classified into two types. 1. Marketable assets and 2. Non-marketable assets. Marketable assets are those which can be easily transferred from one person to another without much hindrance. Example, shares of listed companies, government securities, bonds of public sector undertakings, etc. On the other hand, non-marketable assets cannot be transferred easily. They come under this category. Example, bank deposits, provident funds, pension funds, national savings certificates, insurance policies, etc. New issue market, NIM, versus secondary market. Basis for comparison. New issue market. Secondary market. Meaning. The marketplace for new shares is called primary market, or it can be called as initial issues market. The place where formerly issued securities are traded is known as secondary market or resale market. Buying, direct in new issue market, and indirect in secondary market. Financing. New issue supplies funds to budding enterprises and also to existing companies for expansion and diversification. Secondary market does not provide funding to companies. How can securities be sold? New issue market sells the securities only once. Secondary market can sell securities multiple times. Buying and selling is between. It's between company and its investors in new issue market. Buying and selling is only for investors. Gained person. Company in new issues market. Investors in the secondary market. Intermediary. Underwriters in new issue market and brokers in secondary market. Prices in new issues is always fixed. Price fluctuates, depends on the demand and supply force in secondary market. Organizational difference. It is not rooted to any specific spot or geographical location in new issues market. It has physical existence in secondary market. Thanks for watching my presentation. Kindly like, share and subscribe my YouTube channel Karthik the Guru.